Welcome to Lykken on Lending, the podcast that dives deep into the heart of the mortgage industry. Your host, David Lykken, bringing you the latest insights, trends, and updates from the world of mortgages. Whether you're a seasoned industry veteran or just getting started, this show is your go-to source for all things mortgage. On Lykken on Lending, we're not just about delivering information, we're about delivering it in a way that's lively, engaging, and yes, even entertaining. You'll hear from a wide range of regular contributors, experts who make the complexities of the mortgage business not just understandable, but enjoyable. Our goal? To keep you informed on the operational aspects of the industry. Everything from regulations and compliance to technology and market trends, without ever being boring. We believe that staying up to date doesn't have to be dull, and our interactive conversational style ensures you'll be hooked from the get-go. So get ready for detailed discussions, lively debates, and a wealth of knowledge that will help you navigate the ever-changing landscape of the mortgage industry. Let's get started. This is Lykken on Lending. Now your host, David Lykken.
Welcome, listeners, to another episode of Lykken on Lending. We have joining us today Troy Garris, managing partner of Garris Horn. He's a lawyer, and he is good. I have him in a number of my clients. He's representing business owners across the landscape of mortgage land. He is well known, and he is loved by everybody. He's also attending most of the conferences that are going on out there. Troy's three main activities, we're going to get into that in just a minute, but he does a lot of company build out and M&A. He also works in federal and state regulatory compliance, enforcement defense. There's really nothing in the mortgage world that he can't touch as a lawyer. He takes the time to invest into our industry with his time at conferences and investing to those that reach out to him. I'm really looking forward to it. Troy, thank you so much for being here with me today.
Oh, it's my pleasure, Dave. I'm a big fan, and I love what you do. And the whole industry owes a lot to you. We do appreciate it.
You and I both. We care about this industry. We're passionate about making sure we can make a difference. And that's what I love about you. You are always willing to give back. One of the things you're doing is you're hosting the mortgage banking live stream on YouTube. Tell me a little bit about that. So let's start right off. Promote on that.
Thanks for asking about that. We started that back in COVID times, and essentially we were trying to get information out to the industry in times where there just was a dearth of information. What was going on, what was acceptable, what was not acceptable. You remember the time when there were all the margin calls and people thought overnight mortgage industry may disappear. And through all of that, through the PPP loan madness, through all of that, people needed information. We even put together a conference back then. I was pretty proud of the team. It's about 250 attendees. We had about 50 speakers, including high levels in government, that we put together within a month to try to get information out to people. And it worked out really well. We spent lots of hours, made no money, but it didn't matter. We were trying to make sure that we were getting this out there.
But that's at the heart of who you are, Troy, is you're here to make a difference. And I think the ones that succeed the most in industry are those that are here to make sure the information gets out and benefits people. I think too many times, many people do things only for the money, and you don't. Yes, you are in business. You need to make money. You need to get paid for your services, but as am I. But I think we're more concerned about giving out than the things come back. Give and it shall be given unto you, as that old saying goes, the proverb says. I'm really interested in getting a little bit of your background. Those that don't know you as an attorney, again, you really are excellent as an attorney and as a lawyer for the mortgage space. But give us a little background. I've already covered the three areas you cover, but if you could go a little more in depth on those, that'd be great.
I've been in the mortgage industry as a lawyer for about 25 years or so. And about 7 or so years ago, I joined up with a few like-minded attorneys and said, let's change the way legal services are being provided in the industry. It's been the same forever. Yeah. And it just seems like in this time, things could be different. So we wind tunneled the traditional law firm kind of a concept and blew off everything that we could to strip things down to the bare essentials. And the idea being that we'll trim essentially all the unnecessary costs and bureaucracy that goes around there and try to come up with a model that is more efficient, more streamlined, and provide what we think is big firm insights that most of the people that work with us, they've worked with big firms. They come out of big firms. One of my partners comes out of CFPB. And so they've had those experiences. We bring that down to a boutique, bespoke, tailored approach to the law firm service. And we are fans of creating raving fans, people that really do love what we do and how we do it and why we do it, and try to create just a whole better experience. And so we've slashed everything that we could to zero and tried to make a system out of just what you need, just when you need it, and provide services that way. And that gives us a lot of satisfaction.
Yeah, it does. The clients that we have that are working with you, I'm thinking of several right there in Dallas speaking. They hang on every word you say. It's just good, solid advice. But I want to focus today on LO compensation. It's been around for a while, but I really want to get into some recent changes that are coming about and give us some insight. Maybe you could give us, for those, we have a lot of new people that are coming into the industry, listen to the podcast, as well as some seasoned veterans. Let's lay a foundation. What is L Comp, and when did it come in, and what is changing?
LO Comp really is boiled down, oversimplified a little bit, mind you, just for the sake of ease of discussion. But it's really three things. One is the rule promulgated by the CFPB,
right,
come out of Dodd-Frank, right? Yeah. And it says essentially three things. It says you can't pay a loan officer based on terms of loans or proxies for terms of loans. And terms are the typical things you might think of, things like APR, interest rate, or lien position, those types of rights and obligations of the parties. You can't pay differently based on those terms of the transactions, whether it's one transaction, multiple transactions, one LO, multiple LOs. That's the first thing. The second thing is they have a rule. It's essentially no dual compensation rule. And what that means really is that you can get paid by the consumer or you can get paid by somebody else, but you can't get paid by both. In essence, it's a transparency kind of a thing. In the prior days that you'll remember very well, the loan originators would frequently be getting paid by the consumer. They'd also be getting paid by other people.
Multiple
the amounts they would get
income, you might say.
And people couldn't really figure it out. Dodd-Frank, for better or worse, came along and said, we're going to make sure that if the consumer pays you, they'll know what you're getting paid, so they can pay you, and that's fine. Or somebody else can pay you, but you just can't get paid in this multiple streams of income, like you mentioned. And so that's the second part. So first part is no terms. Second part is no dual compensation. And then the third part really only applies to brokers, and that's a no steering rule. And basically, you can't steer a consumer for the benefit of yourself to a transaction that is better, could be worse for them. Now, the reason that applies really just to brokers is because if you're an employee of a lender, you're only working with one company anyway, so you're not really steering to one company or another. So that's really it in a nutshell, those three rules. And then implementing that becomes very complicated, and people want to figure out ways to make their systems competitive and creative and yet comply with the rules. And so that's the basics of that compensation rule.
And I think the one thing about any entrepreneurial industry, they're always trying to find creative ways to compensate people that create a unique advantage for them. And this kind of took some of that out. And I want to make sure I'm real clear about the multiple streams of income that just came out. What I mean is you could have different sources of income if you're a loan originator. You just can't have them from one single loan. In other words, you can't have the consumer paying you, your mortgage company paying you. I think that's what we're speaking about. What I really want to talk about is what has changed or is changing.
Those are good questions. And so the CFPB is currently, it has gathered information, it requested information, and is thinking about whether and how to change the rule. There hasn't actually technically been a change in the rule since 2014.
Right.
But what has changed really is the aggressiveness of the CFPB itself, and also state regulators who can also enforce this rule. And then I think you couple that with the aggressiveness of the companies that in a very tight market, when rates are high and numbers of loans are way down, people really are looking for ways to attract loan officers, keep loan officers interested in doing business and staying with them. And it's difficult when everybody has the same rule and the rule is pretty restrictive. It is quite difficult to both recruit people and maintain people, especially when there seems to be, with all of this aggressiveness, the rumor is a fair amount of cheating, so to speak.
I mean, there's
and
been a lot of concern
trying to
about
compete
that.
with
I mean, we know that there are people out there cheating. I mean, the reality is we've seen it. We're hearing about it. I get calls. I know, I'm sure you do. But so-and-so down the street is doing that and trying to do this right. And that's one of
right.
those conversations you have with your kids. But I think one of the way to clarify this, you could give us some recent cases that are being litigated under the rule.
There's no specific case that has come out since 2015 or so, actually, that is public, right?
Okay.
And there are exams going on that we're aware of.
Okay, that's what I've been hearing about. So that's why I thought there might be cases, because there's exams, but not yet. The exam does lead to that.
Very well can, and I would anticipate that some of this will. What we hear about, again, and the details could be a little different, but what we hear about is a lot of emphasis on some of the things that the CFPB has come out and said, we're interpreting this rule a little differently than we used to. For example, it used to either turn a blind eye or be okay with, depending on how you look at it, with paying differently on brokered transactions from in-house transactions, for example. And then they recently, about a year or so ago, they came out and said, yeah, that's no longer acceptable. We've talked to some people in exams, and they changed their ways of doing business going forward. Reading between the lines, that's probably not going to turn into an enforcement action on those particular matters. But for people who don't follow that lead, don't read those tea leaves, I think it's quite possible that we could see some exams there. But I also see and hear about and see sometimes in exams other people focus on some of the core items that I think people are, if there is cheating going on, some of the things that people may be cheating on. Things like, it's clear from the rule, at least in the CFPB's view, that a company can't pay differently for whether a loan needs a concession or not. You can't make the LO bear the cost of the concession. And yet we hear a lot that so-and-so does it, big company so-and-so does it, why can't I do it? And it's either true or it's not true, but there's a lot of pressure and a lot of incentive to figure out ways to do that, for sure.
There needs to be clarification for this. And then if you could give us 3 examples where most likely a company could get in trouble under the rule.
Yes, I think that's a big one, where people are finding ways or just allowing the LOs to bear the cost of the concession. There's huge pressure there. I think there's also a lot of companies that have differentiation in pay, and this is okay, actually. You can pay differently if a loan is originated by a lead that you generated yourself as an LO, or a loan that the company just hands you a lead and says, here, go, these people want a loan, go call them and do that loan. And so what happens sometimes is that LOs, they're very clever and they know how to do business. I love them. And they figure out ways to change the category. So they'll change from a self-generated lead, which they get paid more on, to a company-generated lead, which they get paid less on, with the idea that perhaps the concession, again, it's that concession issue,
Part of it
that concession, can be alleviated. Because if they go to the company and say, hey, I need another concession, the company may tell them, no, you've had 3 or 4 this month. We're not giving away any more money. But if they can convert that lead from one category to another, then it becomes less of a problem.
It creates a revenue or margin for the company going and making a concession. They're really trying to be creative in how to get a transaction closed that's got something wobbling a little bit. You applaud them for that, but there's some real clear, bright lines of what you can and cannot do. And changing the origination category, how you originated the loan, whether it came as a referral or direct originated, you got to be really clear on that. You can't be adjusting that down the road. That's a great example. Is there any other examples of how companies can get in trouble?
A big topic right now is the question of 1099 versus W-2 employees. That's a big topic, and that could be a whole topic for a whole conversation, actually, but that's a big one. And that touches on not just LO compensation, but a whole bunch of other categories of rules that people can run afoul of. That's an issue that's out there. And the reason is very simple. It's because if somebody is a contractor, that person, the contractor, can take their own deductions. You, as a company, don't have to pay payroll. You probably don't have to provide benefits. Depends on your plan, but you probably don't have to provide benefits. It makes it a far more streamlined relationship between the lender and the LO, but it is fraught with peril there. But that's a big issue. because so many people would prefer to do it that way if they could. And it's a big if they could.
It has to be done with a counsel. That's why you're trying to do this without talking to someone like yourself is probably the biggest mistake you can make is not getting some legal advice. That's why you out there. And certainly when you work with people, I know how generous you are with your time. I'm not suggesting you give away your time, but I know you'll enter into conversations to help sort things out to see if it's a relationship you want to get into. I encourage people to reach out to you. We'll share that information in just a minute. But what are some other rules that are important when mortgage companies are structuring LO compensation? Any guidance you can give to our listeners?
Yeah, sure. So one big one really, and one that trips a lot of people up is the basic minimum wage and overtime rules, the Fair Labor Standards Act, right?
Yep.
This has been a problem for the mortgage industry since the beginning of time, really for all industries, but it affects us too. And there really are two ways to pay individuals. One is that you can pay them subject to minimum wage and overtime, which means that they got to get at the federal level. There's state level requirements in some states as well, not all states. Some states have their own requirements. But at the federal level, you got to pay $7.25 an hour for every hour they work. That's for every person in America unless they're exempt. And if they work more than 40 hours in a week, you got to pay overtime, 1.5 times their regular rate, which is not just the $7.25 an hour, but it's their commissions. It's really the all-in compensation. So that can get pricey and it gets complicated to calculate. So what people do, especially because they're professionals in the mortgage industry, is they will look for ways to have people be exempt instead, which gets you out of that $7.25 an hour. It gets you out of the overtime. More importantly, gets you out of potentially the tracking of the time, which none of the LOs want to do.
No.
And so for loan officers, there's really only one exemption at all that even could apply. That's called the outside sales exemption. The outside sales exemption is in some ways perfect because for junior loan originators in particular, it's really two things. You have to be engaged in sales. That's what loan officers do, so it's perfect there. And then you have to be what they call customarily and regularly outside any fixed location. Customarily and regularly, there's no firm standard what that is, but a rule of thumb is 50% or more of the time. They have to be 50% or more of the time outside in the field, engaged in these sales activities, meeting people, talking to customers, talking to referral partners, engaged in the selling of their wares, so to speak. And if they do that, there's no particular compensation requirement. You can pay them completely in commissions. You can pay partly commissions, partly some other way. It's very flexible. And everybody loves that to the extent that they can use it. Two problems with that. One is that senior loan officers, they frequently don't have to go out and meet people in the field. People just call them. They can just sit at home and the calls will come in and they can do loans. That's not outside sales, right? And so that's a place where people can get hung up. And another place where people get hung up is they will just ignore what the people do. And as it turns out, the people really are just sitting at home, or they're sitting in the same coffee shop every day, or they're sitting in the same realtor's office every day. And so again, it's not customarily and regularly outside. There's also an issue with licensing. State licensing frequently requires that applications be taken in a branch. And so there's some tension between, on the one hand, the state licensing authority saying, take the application in the branch, versus the outside sales exemption saying you got to be outside. And so you got to find a way to marry those two up so that you can navigate through those two requirements. That's on the LO side. There's an exemption on the branch manager side too, that way better fit actually, that involves payment of a small salary, and then they got to do managerial type duties. And that's actually a pretty good fit, truthfully.
There's just so much about this that we need to get advice on. And that's where you come in, especially when you start looking at the state level. If you could speak to that, we have CFPB at the federal level, but now there's like we have 50 new CFPBs when you have all the state audits. As many states as you have, that's how many new CFPB examiners seem to be coming in. Or talk to that. How much? It's really getting, in some cases, a bit confusing.
It is. And I'll tell you that depending on the state, but the states can be fairly aggressive, and they do seem to be getting more and more interested, and they seem to be getting more and more savvy on what to look for. And so we have a number of different matters right this second that are being brought by the state regulators, and they all talk to each other, and they all talk to the CFPB, and they all talk to HUD. And so the communication between them is pretty free-flowing. And one problem that might crop up with one company in state A can easily flow over to state B looking at that issue for different companies, or even the same company sometimes. And it's a difficult situation you can be put in. And they all examine both for state law and also for the federal law. And usually state law says a violation of federal law is also a violation of state law. But it can really be overwhelming if you get in the crosshairs there.
Wow. Is there any recommendations when you're dealing with multiple states on how to handle that?
There are some different processes that you can use, and the states also have some ways that they work together. They say to try to streamline the process. But I think the primary approach is to really to be proactive and have a good compliance management system. I know you do a lot of that type of work, even advising people on how to make sure your system is in place. You have the oversight, the umbrella that you need. And so having that kind of system in place, making sure that management's aware of what is going on, what needs to be going on, and then placing the right people in those slots and making sure that they're supported, I think can do a lot to avoid the states coming at you from either one state or various states together. Because at the end of the day, they have their list of things that they anticipate, they expect that you're going to have in place. And if you have them, generally speaking, things go pretty smoothly. They go down the checklist and you have your system in place that it helps ensure compliance. Everybody has little things here and there that they may miss sometimes. But the states usually, depending on the state, but usually they look fairly on people who are trying and perhaps not 100% achieving the goal. But I think it's the people where they come in and there's just nothing there that they tend to come in pretty hot and heavy on those. And the only way to do that is to start building. And Rome's not built in a day, right? Start now, put the first brick, tomorrow put the second brick, and keep going.
Keep going. Troy, how can people get a hold of you?
My website is a good place. My email address, troy@garrishorn.com. That's our firm, Garris Horn, LLP. My phone number, 301-461-8952. That phone number goes with me everywhere. I have one phone number. That goes with me everywhere. If I'm on the road, if I'm at a conference, if I'm sitting in the office, it's the same phone number.
Same phone number. That's good.
People can call anytime. It's on the live stream, too. I put it out there. Yeah.
Good. That's good. I appreciate that. You do pick up. I've never seen anyone more willing to answer their phone, even interrupting a couple of the situation you're in and dealing with it. It's right on the spot. It's really good. I appreciate your connect. You're willing to connect with people. Troy, I appreciate you being here. Thank you so much. Have a great rest of your week, and look forward to seeing you in Denver at the conference.
Absolutely, Dave. We'll be there. We'll catch up. Thank you so much for doing this.
Good.
Yep. Talk soon. Take care. Bye now.
You've been listening to Lykken on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lykken on Lending.